Most people still believe gold and silver move because of sentiment or headlines. That belief is wrong, and the market is quietly exposing it right now. What you're watching today isn't a rally, it's a pressure buildup, and pressure doesn't resolve itself with smooth moves. It resolves with breaks. If you miss the mechanics behind this pressure, you miss the entire story. Welcome to Gold Rush Reporter, where we strip metals down to fundamentals instead of fantasies. Before we go further, here's a simple question you should keep in mind. If prices are rising while supply is tightening, what happens when the market can't hide the imbalance anymore? That question is exactly why analysts are suddenly paying attention. Silver has been ripping higher while physical markets tighten. Gold has been grinding upward despite corrections, and the correlation between them is behaving in a way that doesn't fit the bubble narrative people keep repeating. The trigger wasn't a rumor, a tweet, or a speculative rush. It was a shift in market structure. COMEX delivery pressure increased, physical buyers became more aggressive, and the usual paper market buffers stopped absorbing stress as efficiently. At the same time, macro conditions tightened, liquidity thinned, central banks remained active buyers, and the debasement narrative finally reached mainstream investors instead of a niche audience. Analysts who actually look at the plumbing, not the price chart, saw something change. When the market mechanisms start to strain, the price action follows, but only after the imbalance reaches a threshold. And here is the part most people miss. Price doesn't lead the market anymore. Stress does. Which brings us to the question nobody is answering yet. If the stress is already visible, what does that imply about the next phase of the cycle? Most retail investors think gold and silver move because the market feels risky. That's a lazy explanation. Risk sentiment doesn't move metals. Structural imbalances do. Start with gold. Gold is rising because demand is running ahead of supply in a way that the system cannot easily absorb. Central banks aren't buying because they're bullish. They're buying because they're structurally reducing dollar exposure. That's a policy shift, not a mood shift. When the biggest buyers operate regardless of price, they remove metal from circulation. And when metal disappears from the float, it tightens the entire market, even if prices don't spike immediately. Meanwhile, supply is not responding. Mining output is constrained by operational problems, outdated capital expenditure, and geopolitical friction. You cannot turn on the faucet in mining. It takes years, not months. So you have a demand curve that is accelerating while a supply curve that is flat or declining. That is the core reason gold holds its ground even when the chart looks messy. People also misunderstand the relationship between gold and rates. Gold doesn't merely benefit from rate cuts. Gold benefits when the traditional rate-gold correlation breaks down, which is exactly what we're seeing. Investors no longer trust the old relationships, so gold behaves more like an insurance asset than a yield competitor. Silver is even more misunderstood. Many people shout shortage, but they confuse two different things. Physical availability globally, which is fine. Availability at current price levels to clear paper contracts, which is not fine. Silver isn't gone. It's not sitting where paper traders expect it to be. When COMEX and London warehouses draw down while ETF holdings start creeping up again, the balance tightens. That tightening pushes lease rates higher. A clear sign that metal is expensive to borrow because it's scarce on a short-term basis. Industrial demand adds another layer. Silver is not just a monetary metal anymore. It is embedded in solar, EVs, electronics, sectors growing faster than mine supply can keep up with. When industrial demand increases and mine production stagnates, the surplus shrinks. When the surplus shrinks, the market becomes sensitive to any investor flow, even small ones. People expect silver to crash back to the 30s because they think it behaves like a speculative asset. It doesn't, not in a tight market. When a market is tight, volatility expands, but the directional risk shifts upward, not downward. Here's the part almost everyone misses. Silver lags gold during the early phase, then outruns it at the end. That's a cyclic behavior rooted in liquidity and size, not hype. Now put everything together. Gold tightening because of central banks, supply constraints, weak recycling, ETF demand, waking up. Silver tightening because of physical drawdowns, industrial demand, rising lease rates at multi-decade highs. Paper markets, stressed investors finally waking up. None of that looks like a bubble. It looks like a market where stress accumulates quietly until it becomes visible in price. And here is the insight you should carry forward. When both gold and silver show tightening simultaneously, the market enters a regime where price is no longer the leading indicator. Stress is. That shift is the real story. And the question no one is answering yet, the one that will define the next chapter, is this. What happens when the stress reaches a point where paper mechanisms can't absorb it anymore? Let's cut through the noise. People talk about gold and silver as if they moved because sentiment shifted or traders got excited. That narrative is convenient, but it's wrong. What actually moves these markets is stress translating into price when the plumbing can't absorb it anymore. Start with gold. Gold demand is structural. Central banks, sovereigns, long-term allocators. These buyers do not care about short-term charts. They care about reducing exposure to the dollar and accumulating an asset that cannot be diluted. When that demand accelerates, it pulls metal out of circulation. Not because prices rise, but because the buyers are insensitive to price. Now combine that with supply that cannot respond. Mining projects take 7 to 10 years from discovery to production. Operational bottlenecks, energy, permitting, geopolitical risk, slow output further. So the gold market ends up with steady demand, plus stagnant supply. Most analysts still frame gold as rate sensitive. They miss the shift. When the marginal buyer is a central bank, gold becomes rate indifferent. You can't model that with old correlations because the drivers changed. Silver is the more interesting case because it sits at the intersection of monetary and industrial demand. Everyone who screams silver bubble is projecting a speculative asset model onto a market that is behaving like a tight commodity market with financial overlay. Those two behave differently. Here's what actually matters. 1. Physical tightening. Psychological tightening. When warehouses draw down, investors notice. When investors notice, they stop treating silver like a trade and start treating it like a hedge. That subtle shift triggers holding behavior instead of flipping behavior. Holding behavior reduces free float. Less free float. Higher sensitivity to flows. Higher sensitivity, more volatility. Volatility, more fear. Fear, more buying from those who understand the fundamentals. This cycle is not hype. Strip away the rumors, the headlines, the noise about manipulation, bubble, or blow off. Strip away the charts, the predictions, and the emotional reactions. What remains is a simple, uncomfortable truth. Gold and silver are not moving because people feel bullish. They are moving because the system underneath them is under pressure. That pressure comes from debt that cannot be contained, liquidity cycles that keep breaking their own rules, supply that cannot expand industrial demand, that does not pause, and paper mechanisms that are losing credibility while physical demand keeps rising. These forces do not cancel each other out. They stack. When forces stack, the outcome is not subtle. It is a shift, sometimes slow, sometimes sudden, but always violent enough to reset expectations. Gold absorbs pressure quietly until the imbalance becomes undeniable. Silver reveals pressure early because it has a physical bottleneck and a financial overlay. Both metals point in the same direction, but for different reasons and on different timelines. And here is the real takeaway. The opportunity and the risk sit in the same place. A market that is structurally tight, psychologically shifting, and financially fragile. When pressure expresses, it will not look like normal volatility. It will look like a repricing event. You don't need fantasies about triple digits or catastrophic collapses. You don't need conspiracy theories. You only need to understand structure. When structure weakens while demand strengthens, price is forced to adjust, not because people want it to, but because the market cannot absorb the imbalance any other way. That is the axis everything else revolves around. Outro. Gold Rush Reporter. This is the kind of environment analysts miss because they focus on noise instead of mechanics. Here, we look at the mechanics. No hype, no predictions, just structure. You're watching Gold Rush Reporter, where fundamentals cut through the noise. Stay sharp, stay analytical, and we'll break down the next shift together.